Hi, I'm Dina from P2M Asset Management. I'm an independent financial advisor with over 20 years experience in financial planning for businesses and individuals and families. So I specialize in mortgages, residential and buy-to-let, and also in the protection world in life, critical illness, relevant life policies, key man cover, home insurance, and then the later stages of life, which is wills and estate planning. So today we're going to be talking about business protection. Why is business protection so important? So I'm going to talk to you about a quote that Andrew Carnegie had actually said. Men and women, not machines, the real source of profits in any business. Take away my factories, my plants, take away my railroads, my ships, my transportation, take away my money. Strip me all of these, but leave me my men and women, and in 2 or 3 years, I will have them all again. So what is he trying to illustrate? He's basically saying that all those material commodities that we have in business don't allow us to restart. So at the moment, we're going through a pandemic. Our people are the most important tools that will re-kickstart us again and allow us to go back out there in the world that we are today and reboot our businesses. So a great quote from Andrew Carnegie, a great one for leaders to obviously believe in going forward in the business world. So today we're going to discuss business protection. There are 3 to 4 different types of business protection. It's so important for all of us to ensure our personal lives, ensure us as individuals. But a big part of our lives is actually the business. It's an individual in itself. So it's really important to make sure that we ensure the people within our business and ensure the business itself, that if we are not around, the business owners, going forward, the business can sustain. So the types of policies I'm going to go through with you today is relevant life plans, shareholder and partnership protection, and key persons cover. Why do we need to protect our business? One of the key reasons why we need to protect the business is of loss. Individuals in our business make our profits. They are key tools ensuring the profitability of the business. So it is our responsibilities as business owners to ensure that the people in the business are actually protected. There are other reasons why we would need to protect our businesses. It's just in case we've ever taken out loans. A lot of people take business loans out to purchase their property, their warehouse, or actually to just ensure our profits. Also, another reason why we would want to protect our businesses is actually the shareholders and the partners within the business. If anything was to happen to your business partners, you would potentially lose control of the business. It could be that their husbands or their wives want to come in and take over the business. So it is essential that we provide financial compensation for the family of the deceased partner or shareholder. So firstly, we're going to talk about relevant life plans. The basics. What is a relevant life policy? Who is it paid to? Now, relevant life policies generally only come in life-only basis, which basically means in the event of death, the policy is paid out, and I will talk you through who it's actually paid to. So there's many policies out there. A lot of providers of actually wrap it round and call it different things, but the fundamental basics are exactly what I'm going to go through now. So the relevant life plan covers you for life cover. Terminal illness is commonly included. The employer actually pays for the policy. So who pays for it? It's actually the employer or the business owner. Who do we insure? We actually insure either the business owners, or it could actually be members of your staff, members of your team. It doesn't have a surrender value. What that basically means is it's not a cash-in policy. It's not a savings plan. It's a protection plan. When does a policy end? Most policies end at the age of 75, which ties in quite nicely to commonly when people would look to retire. So you've got to remember, this policy is for people who are working within your business. So if you have a set retirement date for them, it's common that you would actually set the end date of the policy in line with their retirement date. The benefits that are paid out are can be put into a trust, and it has to be put into a trust right from the beginning. What does that mean to you? What that basically means is the money that is paid out gets paid out to the family, gets paid out to the loved ones of your staff. So, for example, if your staff is married, we've insured him, the monies will actually get paid out to his wife or his children, whoever he decides to put the funds into the trust to. The other benefits as a business owner is it's actually a taxable expense. So the monthly payments that go out of the business accounts, they can be reclaimed back from the HMRC, which would obviously give you benefits of paying slightly less on the corporation tax going forward. As I mentioned earlier, what do you need to know about relevant life policies? Who is it available to? It's actually available to employees and shareholdings of the limited company. I mentioned life cover, and it must be put into trust from day one, on the minute we actually take the policy out. The maximum term is 75 years, and it is not a cash-in policy. Both the premiums and the benefits are fully tax efficient. So the premiums I've mentioned a minute ago is a taxable expense, but the benefit that is paid to the family member is actually tax-free. Okay, so it's a great policy to provide to your employees as a benefit for them to be working for you. Who is it relevant to? Who can take this policy out? So an employee of a sole trader, as long as they're an employee, they can benefit from this plan. If they're part of a partnership, they can benefit from the relevant life policy plans. Limited liability partnerships, limited company, or as I mentioned before, shareholder director who is also employed by the limited company. So the key thing is they need to be employed. So RLP came into the space because many of the small, medium enterprises, otherwise known as SMEs, didn't have access to these type of benefits. So a few years ago, about a decade ago, the insurance companies came out with this solution, which was the relevant life policy. So it was great for the small to medium sized businesses that could actually benefit from providing their employees a benefits package. It wasn't just attracted to the high earners. However, high earners did enjoy utilizing their lifetime allowances by taking out relevant life policies, because it sat outside their estate because the policy was written in trust. And also it's actually a benefits commission package or a profit package to employees. So it was part of their rewards. So a lot of smaller businesses could offer these as a perk to their employees rather than just offering pay rises. I'd mentioned the taxation benefits earlier. So the premiums are actually, what I didn't mention to you is who are the premiums paid by. The premiums are actually paid by the employer, and they are deducted as a business expense. The premiums are not assessable for national insurance contribution, so that you don't pay extra national insurance just because your employer is taking out an RLP. Premiums are not classed as a benefit in kind. Now that's the key difference. So many employees offer, cars, corporate cars, company cars. Also, they offer private medical insurance. But all these benefits are classed as benefit in kind. So the employee has an additional tax to declare to the HMRC, whereas an RLP wouldn't have that. It's free of income tax. So I mentioned earlier the employee's beneficiary who would actually gain the sum assured in the event of death or terminal illness, it would be free of any form of tax, and it's also free of inheritance tax because it's actually put into a trust at outset. So this is a typical example of tax savings. So you have a normal life policy that one would take on an individual basis, and then you have the relevant life policy. So assuming that was £1,000 annual payment, on a life policy, paying £1,000, you would pay £34 national insurance, and the income tax you would pay on that, assuming you're a high rate taxpayer, would be £690. And the employer would then on top pay £238 as national insurance employer contribution, and then they would have to pay corporation tax. at 19%. So the total cost of that insurance from what the employee would have paid and from what the employer would have paid would actually be £1,589. Now to look at the relevant life policy. So the same £1,000 annual premium, as I mentioned before, there would be no national insurance to pay, there's no income tax to be paid, and there's no employer national insurance tax to be paid. And as I mentioned, the employer can actually claim it as a business expense. So there's £190 that they're saving on corporation tax. So the actual cost would actually be £810. So the total saving from a like-to-like comparison is £779. So that's a huge saving in comparison to if you were taking the same life insurance out on an individual basis. So a lot of employers are benefiting, providing the same insurance, and for obvious reasons, individuals are also benefiting because they are having to pay less tax. So we talked about limited company owners or limited company directors on the previous conversation. I'm now going to talk about shareholders and partnerships. So in any event where there are more than one person as part of the business model, you would need to ensure that you were looking to protect the business if anything had happened to one of the partners. So the issues that you would possibly face is who is the control going to go to? For obvious reasons, most business owners wouldn't want it to go to their spouses because they may not be an integral part of the business, but that is exactly what potentially could happen. So ensuring that you have shareholder protection or partnership protection in place, we ensure that the control goes into the right hands. And the partner or the shareholder's family may not be where you want, the business shareholding to go to. So making sure the right people have received the cash at the right time is essential. So as a spouse, if anything happened to your partner and he's an integral part of the business, they would want to make sure that they get paid their value of what that business is worth in the event of their spouse demising. So to ensure that you can do that, you need to make sure you have an insurance policy in place, or you have enough funds kept aside within the business to ensure that you can pay out. So a lot of business owners would ensure that they would take, shareholder protection for the unfortunate event. So in a business partnership, not always do business partners have a business will. What is a business will is where you would, just like an individual will, you would actually ensure that your wishes are written, that in the event of a business partner's death, whom do you want your shares to go to, and what value are we putting on those shares? So without business protection, what could happen? What would the situation be? So here I've got an example where Brian Boscombe's share was passed on to his wife, Brenda. So the surviving directors could potentially lose control following loss of one of the business owners in this scenario. So the surviving directors have now lost control because Brenda's now come in and wanting to take over the business. Can they afford to buy the shares? Because if they don't have business protection, you need to ensure that you've got enough funds within the business. Question is, would the spouse even want to sell the shares? Because if she doesn't, and she's like, well, you know what, I'm going to come and take over the business, then we have real problems, not just problems with the way the business is going to run, but obviously the profitability of the business. Then you have those who have entrusted you, whether it be for a loan, whether it be for finance, whether it be for credit. So how would your suppliers react? How would the bank react? How would third-party relationships react? So there's a lot of impact when a business owner has died, because the relationship, whether it be the financial or moral relationship or the business relationship, is all to do with that individual. So the problem checklist could just be ever growing. So for example, Brian's widow's problem as an individual, as a widow, she's like, well, I've got a loss of income. My husband's now not part of this business. I'm not going to get the dividends. I'm not going to get the income to then maintain my family lifestyle. But however, she doesn't have the knowledge of running the business. Now that could take years for somebody to go, and they may not even be capable. So they actually may not even have the right skill sets to come in and take over the business. And it could then mean the business starts failing, and then the value of that business is decreasing. And then you're not going to be able to find a buyer, because no buyer is going to be wanting to buy a business that's actually going downhill. Other directors, the staff, the key people are now more demoralized. They possibly left the business, joined other companies. So all around you, that business is actually vacuuming downwards, only because one director is no longer there. So a surviving director, so there's other directors also, they're part of the business, but they're now handcuffed. They're now sort of hung in one corner, because the widow is now becoming a real nuisance, because she's possibly grieving. She's now wanting to know how to do everything. She's come in with a lot of power, wanting to learn, but actually doesn't have the skill sets to be within that business. The other directors could be thinking, we should be liquidating. We need to start again. There's the loss now of the knowledge, the experience that the director who's died had. And if he was the face of the business, there's also the external part of what the world knew of that individual, and what the world knew of that business. But all the widow is obviously concerned about is the lack of money. Her biggest thing was the lack of money at this stage. So what could have been done? What could have been done is what we now need to think about, what all business owners need to think about. So business succession planning is very important. What are your options that the business owners would have had if they had insured that director, if they had come up with a value of what that shareholding would have been worth, and they had an insurance policy in place that would pay out in the event of that director's death. The widow would have had a sum to carry on with her life, and the biggest issue of loss of income wouldn't be there. And the existing directors would have had possibly remained control, because that business insurance policy would have paid out the widow, paid for the existing director's share, and the shares would have come across to the existing directors, which would allow them to continue to run the business and possibly recruit another director or recruit key people, and not to go through the difficulty that they could have gone through if the widow had actually come into the business. So how would they assess a business? There's different ways. Generally the rule of thumb would be 3 years average net profit pre-tax times 5 years. Very common, the accountants would use that, or an average multiple. 10 up to 10 is also possible. These multiples differ in different types of businesses. Legal business, accountancy business would possibly use a different multiple. Manufacturing businesses would use different. There is no real right value. It's up to the directors within the business to create a value on your business to make sure that you are insured, so you can pay out. When we are talking about shareholder protections, there are 3 different ways that you can actually establish a shareholder cover. One is life of another. The other one is own life in trust. And the third one is company buyback. I'm going to go through all 3, so there is clarity in what approaches you can take when you look to consider shareholder protection. So life of another is very simple for small businesses, but it's very inflexible. So Jack and Sue are business partners. Jack would take a sum assured of 200,000, which will cost £1,200 an annum, and Sue would take £400,000 worth of cover. That would cost £800 an annum. So each one is actually insuring the other. So it's life of another. So Sue would insure Jack, and Jack would be insuring Sue. So if anything happened to either one of them, the sum assured will be paid out to the other person. This is slightly complicated. So this is commonly where you've got limited companies. It's only available for limited companies. So you have the company there, and the company is then insuring, Sue and Jack. We've got the same faces there. And what it does, it pays for the insurance of the directors but then on the event of death, so we had Ben's death earlier on, it would actually get paid to the widow. Company pays for the insurance. It's insuring the individuals, the 3 directors, and in the event of anything happening to the director, it would get paid out to the spouse, and the shares would come back into the company. So we paid the value out, and the shares are coming back into the company. And then we have thirdly, own life and trust. This is generally for slightly larger businesses. So each person takes out a policy on their own life. And then it's written in trust for the remaining partners or the shareholders. So a business trust allows for future changes to the business structure to cope with new or retiring partners. Each individual is taking a share value or an amount of insurance on the other partners or the shareholders. And in the event of death, it's been paid out to the shareholders. So in that scenario, what would actually happen is you would have a cross-option agreement put in place. So because you're taking insurance out on another one of the shareholders or directors, we need to make sure that shares come back to you or come back to the business. So in this scenario, you've got a policy that's paid out to Bob, but he's then got an agreement. Mark can buy those shares. So another shareholder can then buy those shares back. So just to recap there, so how is a partnership or a shareholder cover set up? It's purely a commercial arrangement. So who would actually the policy holder or the owner be? So it would either be the shareholder or the partner. Who would the life assured be? What is the definition of life assured? Who are we insuring? We're actually insuring either it will be the partner of the business or it will be the shareholder. Who gets the actual benefits? It would be the trustees for the benefit of the beneficiaries. Would the policy be written in trust? Yes, it would. It would actually be written in a business trust where you then have the cross-option agreement that stipulates what will actually happen to the shares. So company or partnership involved, none of them would actually be involved. There'll be an agreement set in place that would literally stipulate on once these benefits come into the business trust, whom are the shares to go to, whom are the funds to go to. So the taxation, can the premium be classed as a business expense? When the individuals pay their own premiums, they cannot be classed premiums as a business expense because the individuals are paying for the premiums. Premiums will be treated as earnings of the director, and the company will therefore be able to deduct them as an expense. Okay, the director will be liable to pay income tax and national insurance on the premium because the premiums are paid by the individual, not the company. If a claim is made, is the benefit taxable as a trading receipt? You've got to remember the company is paying for this under the shareholder. No, because the benefit is received by the individual rather than the business. Okay, so there is no tax payable for there's no corporation tax. The third type of cover we spoke about earlier is key persons cover. This is taking us a little bit away from family members. It's more as a key person, you're a family member to the company directors. I suppose it's much the same, but in a business avenue. So you need to identify who are the key people. For example, you might have a sales director, you might have a financial director. These are key people that the business could not function. I wouldn't suggest your administrators are generally the key people because you could recruit and you could get someone in pretty quickly. Certain companies, for example, architects, they may have designers, they may have specialists, they may have technical experts, which are really integral part of the business, whom do key functions and actually create a lot of turnover and generate a lot of profits for your business. So that is the key thing. Which individual in your business are integral in creating a larger quantity of your turnover or your profits? What would happen if they're not here? Profits would fall, especially if they're integral to the the bottom line. There'll be inability to possibly service debt if there's a loan against the company. There could be cash flow constraints. There could be the time-lapse period of how long it takes to recruit and train and develop somebody to be at the level that your key person was. Businesses generally look to insure machinery, vehicles, property, third-party people coming within your business through public liability. People insure their stock. People insure the premises, whether it be the contents of the building. Sadly, 57% of businesses have no key person protection. That's an awful lot. I guarantee 57% of people who have not insured their debt, or not insured their property, or not insured their stock. But human nature is the most important part of a business are individuals. But sadly, a lot of businesses fail to insure them. So again, how would a company trade if the key director died or suffered a serious illness? We spoke about it earlier. It'd be very difficult. You potentially would lose a leader. You would lose a salesperson. You would lose a finance director, a company secretary. How would the loans be paid? How would the tax be paid? The other directors would have to start building confidence with the banking relationships. A lot of directors give personal guarantees. So in business, whenever they've taken out business loans or even trade credit, directors are asked to give personal guarantees. So it's the big word trust. And that trust takes a lot of time to build. So it's essential that you have security in place and financial security in place to give you enough time to rebuild that and rebuild those relationships, or another director to start learning areas of expertise that they may not have been involved in historically. So the ideal questions you need to ask really when we're thinking of key person cover is, who is missed most when on holiday? There's always those members of staff that you feel the absence, and not in terms of personality, in terms of, oh my God, we really, this person's a key part of my business, and I can see that we face difficulty when they're not here. What skills does that person actually possess? And is there a contingency to cover their loss of knowledge or skill or attributes when they're not around? What would it affect business expansion or development if that person wasn't here? Would it result in loss of goodwill or hardening of supplier credit terms, which I mentioned earlier? What view would the bank take if that individual wasn't around? Would the company afford its loan repayments? Will any director's loan need to be repaid? And how much profit would be lost? How will the company cash flow be affected? Would it leave you vulnerable to competitors who may be able to exploit the situation? So as a business owner, I think it's crucial to ask yourself these questions. Then that will allow you to understand who are the individuals who are integral to your business, who you need to consider taking out key persons cover for. There's key things when we need to look at in terms of the amount of cover that we need, because you've got to remember we're actually ensuring that individual for the benefit of the business here. So we're ensuring that if that person wasn't around, how much would it cost me to retrain somebody? Or how much profit would I lose in that period, whether it be paying off loans, business liabilities, or retraining? So you need to ask, what is the replacement cost of my profits, and what would my business liabilities be for a length of period? And that will allow you to come up with your sum assured of how much cover you need to ensure that you have in place for the short term, to allow you to recruit and get another individual in place to do that same role at the same level, ensuring your profits are not jeopardized. How do you calculate loss of profit? That's it's an individualistic one, I would say. But gross profit attributed by that person, you may have some sales targets. You would have some form of way that you measure, especially if they're in the sales arena. And you would possibly calculate it by the number of years it would take you to recover that profit. Okay. and how much it will cost you to replace that. So replace the individual. There might be recruitment fees. There could be, benefits package that you have to offer because you're having to go out and pay a little bit more than you to recruit the right person. So salary replacement costs, training, recruitment, you need to total that up to allow you to come with a figure. So business liability costs plus the loss of profit and replacement would be the actual figure that you would need to be considering to insure that individual. So the policy is taken out on life and another. So the business would be, the company would be the owner of the policy. The actual person that they would insure would be that key person. The company would pay the actual premiums, and the company would actually receive the proceeds. Okay, because it's for the company's benefit. It's not for the individual's benefit. It's not for the director's benefit. It's for the company's benefit. So in the event of something happening to the key person, the sum assured would actually be paid to the business. So now we're going to look at how is it taxed. The benefits are taxed. They are taxed as a trading receipt into the business, because the sum assured, for example, the 100,000 cover will get paid into the business, and the premium possibly could be taxed. Now, this is a real accounting question, because there's the Anderson guidelines that is actually followed in assessing whether the actual premiums would be treated as a taxable expense or not. So the Anderson principle, whether how to assess whether those premiums were to be taxed, is quite complicated, but I've tried to keep it quite brief here. So no corporation tax relief on premiums if the shareholding is above 5%. The policy is set up to cover a loan. So if it's for a business, if the policy was there to pay for a loan, or the amount is to pay for a debt, then there would be no corporation tax relief on the premiums. It would be classed as an expense. And how to satisfy the Anderson rules for tax relief on premium, the individual that we're insuring must be employer-employee relationship. So the individual must be an employee of the company, must cover the loss of revenue, trading profits, or income. The sum assureds need to be reasonable. You can't just, if you're paying 20,000 salary for a member of staff, and you decide that you want £1 million cover to replace the loss of liability and the loss of income and recruitment and training, that is not reasonable, because hypothetically you could come up with any figure. So to meet the Anderson rules for the tax relief on the premiums, these are key conditions that have to be met, and it must be for a short term. So generally a key person cover is about 5 years, whereas a business, business life, relevant life policy, like I said, you could do up to the age of 75. Shareholder protection, you could put up to 65 in terms of, when the director was looking to retire. But key persons cover is generally between 5 and 10 years, because there's no guarantee that that individual is going to be with you for 5 years, or would they actually continue to be your key person? You just don't know. And the local inspector of taxes should be informed and consulted. So when you take out key persons cover, your accountant would be aware of it, because they would see it, coming off your balance sheet, and also you would provide that information to your accountant. I am a 28-year-old business owner, and I want to get protection insurance. However, my 28-year-old business partner says that it's not worth it, because we are both so young and therefore unlikely to die soon. What would you say to convince my partner that they are wrong? Well, none of us actually know when death is coming, quite frankly. If you have a profitable business and your business has a value, your age is irrelevant as far as I'm concerned, because whether you are 28 or whether you are 60, if you have a profitable business turning over £500,000 and you need to safeguard that business and its profits, and you want to ensure that your partner is paid in the event of your death, then I would suggest that you do take a form of insurance out. And don't forget, the business is paying for it. The individual, you as an individual, are not paying for it. And funny enough, I'd like to share this with you actually, that whenever I tell individuals that you need to take out protection to make sure that your loved ones are protected in the event of you not being around in your business, business owners, when I say to them that your business will pay for the insurance, or the business could pay for the insurance, they're more likely to take the cover out. However, when I say to them, you need to pay it out of your personal account, it's amazing how the sum assured drops, because they are personally having to pay for the premium rather than the business. So utilize your business to protect your loved ones, the directors in your business, and the key people in your business. I own a company with only 2 employees. Would you recommend that I get key person protection for both members of staff, even though they are low skilled and only technically responsible for output? Good question. Now, they may be just technically there for output, but if that technical knowledge or that technical ability is integral to you getting the sales and the revenue to your business, then that is a key person. So my answer to you would be, if without those 2 individuals, your business could not function and you could not gain the profit that you are getting now, then yes, you would need to look at key persons. If you feel that, well, actually, you know what, I will be technically astute, the stopgap could be yourself, and you have that technical ability, then you may not need to take out the insurance. Also, something I wanted to say was, you need to make sure the business can afford. It's great to have all these insurances, but at the end of the day, we need to have that happy medium that the business can afford to pay for these insurances, as well as sustain the profit that you wish to see and the overheads of running your business. What happens if I have key person protection for a member of staff, but they are then fired before their full protection term is completed? Do I get my money back, or can I put their replacement on the same plan? Good question. This is not a cash-in policy. It's an insurance policy. So what key person cover actually does, it covers that individual. So it's that individual's age, that individual's health, if they're smokers, non-smokers. So if an individual does leave your company, then that policy would lapse, and you would need to take out a new policy on a new member of staff. Okay, and there is no cash-in policy. It is not a savings plan. It is an insurance policy. So one of the questions that have come in is, does the cost of life insurance vary depending on the seniority of the person you are insuring? For example, partner versus employee. Assuming the partner is older and the employee is younger in that question. The insurance is based on a few things, few facts. One is your age, one is your gender, male and female. Fortunately, insurance companies have now come to a bit of a level playing field when it comes to insurance premiums. But the key things is actually age, your health, so any pre-existing medical conditions, whether you smoke or not. So the insurance companies will actually assess the risk factor, and it is only then that a premium would be actually proposed to you. So talking about, these factors, I'm just going to quickly go through, what is the process. So when your advisor would do a quote for you and they quote you a premium, doesn't mean that's exactly the cost that the business or the individual would have to pay. The process would be, the quotation's been done, an application form would be filled out, various medical questions would be asked from the individual that we're insuring, and they would possibly contact their doctors to gain a medical report. And once they have done what we call the medical underwriting, terms are issued. So on those terms, it would be the actual premium the insurer is actually proposing, and any conditions that they may think that they don't wish to cover you for, or they may say, well, you're slightly higher risk, so actually we're going to rate that premium or load that premium by 20%, 30%, depending on their risk factors. And once you have that final premium, it would be up to the company director or the partners to decide that yes, we're going to be looking to proceed. So these factors are all considered when the life insurance company are looking to insure you.